Hello! In this video we're going to walk through short exercise 9-11. This is not a hard exercise, we'll just do it step by step. So, short exercise 9-11, we have a company that borrowed money by issuing $2 million of 4% bonds payable at 97.5 on July 1st, 2014. The bonds are 10-year bonds and pay interest each January 1 and July 1. So those are our facts. Now just kind of dissecting what they're telling us there. The $2 million is the face value of those bonds. The 4% refers to the interest rate that is paid per year on those bonds. Those bonds pay interest twice a year, so basically they get half of that interest each 6 months. 97.5 is the price of the bond. So that's 97.5% of the 2 million is the price. When we say the bonds are 10-year bonds, that means they have to be paid back in 10 years. So let's go with question 1. How much cash did Moonlight receive when it issued the bonds payable? Journalize this transaction. Well, how much cash it received would be the $2 million times the 97.5%. So what we're going to see here is we're going to see the cash first. So cash, they're getting $2 million. Moonlight is borrowing the money. So 2 million times 97.5% is 1,950,000. Now I would skip the discount on bonds payable line for a moment and do the bonds payable line. The bonds payable credit is the liability, and we're going to credit that liability to increase it. So we've got cash, a debit of 1,950,000. We've got bonds payable credited of 2 million. The difference between the two is the 50,000. It has to go on the debit side because the journal entry debits have to equal the credits, and that's going to be discount on bonds payable. This bond is paid at 4% is less than the market rate. We don't know what the market rate is, but we know it has to be less than it because these bonds sold at a discount. We also know it's a discount because the price, 97.5, is below 100, and 100 is par. So this discount would be debited. If this had been a premium, we would have a credit, and it would be on the other side to make our debits and credits balance, and it would be called credit on bonds payable. Okay, so that was number 1. Number 2, how much must Moonlight pay back at maturity? When is the maturity date? Okay, how much must it pay back? Well, the maturity, what they have to pay back at maturity is the 2 million face value. They have to pay back the face value at maturity, and the maturity date is 10 years from the issue date. So July 1st, 2024 is 10 years from the date of issue. That's it. See, that one's not bad. Then question 3, how much cash interest will Moonlight pay each 6 months? Okay, so for cash interest, what we're going to do is we're going to take the face value of $2 million times 4% times 6 months divided by 12. Alternatively, we could, so what we're doing there, 2 million times 4% annual rate times 6 months out of 12. Every 6 months, so 40,000. We could have said, let's take 2 million times 2%. We could take 2 million times 4% times 1/2. They're all equivalent. Okay, and then finally, number 4. And number 4 is probably the most challenging part of this exercise, but it's still not bad. How much interest expense will Moonlight report each 6 months? Assume straight line amortization method. Okay, so interest expense is going to be composed of 2 components. The first one is the cash interest. This is this $40,000 here. The second one is the discount. Remember when they sold this, or when they issued it at a discount. They issued it for $1,950,000. We did that back in part 1. So they had a discount of $50,000. So let's go back here to part 1. Discount on bonds payable at $50,000. Well, if we take that $50,000 and divide by 10 years, that's $5,000 per year, and then divide by 2 because it's twice a year. So basically, you could take 50,000 divided by 20 periods. So let me do that again. Okay, 40,000 is the interest we calculated in part 3. 50,000 is the original discount divided by the number of interest periods. These bonds pay interest each January 1 and July 1. So there are 2 interest payments a year, and these are 10-year bonds. So 2 interest payments a year times 10 years gives me the 20. So my interest expense every year is going to be the cash interest of $40,000. We calculated that in part 3. And then we're going to take the amortization of the discount, the $50,000 discount divided by 20 interest periods. Again, 10 years times 2 per year. So my interest expense is going to be $42,500. Now up is we're going to finish this. That was the first part of part 4. The next part of part 4 says journalize the entries. Now the entry, this is an amortization of a discount. We're going to debit interest expense for that $42,500 that we just calculated. We're going to credit discount on bonds payable for the amortization part, the $2,500. $2,500 is the $50,000 divided by 20 interest periods. 50,000 divided by 20 is 2,500, and then interest payable is the 40,000 that we calculated in part 3, the cash interest. And then the last part of this, still the last part of the sentence says, write the journal entry for the payment of interest on January 1st. So this was December 31st. This is when we were accruing interest, recognizing interest expense. So January 1st, what we're going to do is we're actually going to pay the $40,000 cash. So we're going to debit interest payable because we no longer have that liability. We're going to credit cash because we're paying cash then. And that's it on this one.